In this video, we're going to be talking about the 5 rules to successful dividend stock investing. When it comes to investing in dividend stocks, there's a lot of different things that people start to consider and different things that people start to look at. So I'm going to break down my top 5 rules that it takes to be a successful dividend stock investor. We'll also be looking at 3 stocks that I just bought, how much I bought of each, the dividend yields, different things like that. So before I go any further within this video, all I ask, if you find value and if you enjoy it, you make sure to give the video a thumbs up and you subscribe to the channel. You turn on post notifications for videos coming out every other day. I'll see what you guys are doing and thinking, so make sure to leave a comment below if you agree with these rules, or if you have any other rules, I'll see that stuff. But enough of that talk, let's get into the video. So what we're looking at is my portfolio right here. The M1 Finance has been acting a little bit funky over the past few weeks. You can just see like it doesn't give me any returns since past November 15th of 2021. But you can see I have 24 holdings, a dividend yield of 3.416, and an expense ratio of 0.06%. I'm actually in the process of reevaluating my portfolio. I want to get my dividend yield a little bit lower. Now you might be thinking that sounds crazy, but that is because I want to aim for more dividend growth rather than high yield positions. So I'll probably be trimming some positions in positions like QYLD. Not saying that it's a bad ETF, just not for my investment style right now. I'm still going to own some of it, but I do own a lot more than I think I should. And I'll probably put it into companies like Microsoft, Lowe's, Home Depot, Starbucks, more dividend growth oriented stocks. But let's talk about, first off, stocks that I bought. So right now you can see I bought Lowe's, Microsoft, and Upwork. Now Upwork is actually not a dividend stock. They have a 0% dividend yield. This is more of a growth play, and I'm buying this on the dip. This stock was literally recently like $62 a share, and I've been invested in this company since they were like 20. And I believe in this company for the long term. It's one of my few growth stocks. I literally own 3 growth stocks, and everything else is dividend. But this is one of my favorite growth stocks, and I thought I needed to buy the dip. So I bought 30 shares at $40.37, total cost of $1,211. No annual income on that because it is not a dividend stock. Now we got Microsoft, which is a dividend stock, and Lowe's, which is another dividend stock. I bought 1 share of Lowe's at $252.63 per share. Lowe's has a dividend yield of 1.27%, and it cost me $252. Gives me an annual income of $3.20. Microsoft, I only bought $100 worth, and it gave me 0.296 shares with a dividend yield of 0.3%, 0.73%, and an annual income of 73 cents. That added my annual income by just below $4. But let's talk about the 5 rules to dividend stock investing, which is what you came here for. So, rule number 1, don't chase high yields. I'm going to actually zoom this out so we can get a better zoom in. So, rule number 1, don't chase high yields. Most of the time, a company has a super high yield, they're just going to cut and reduce it, okay? So these companies, they need to attract investors. And most of the time that these companies have such a high yield, the only way they can attract investors is by having a high dividend yield. And it's very bad, okay? It's not good practices, okay? And most of the time, these companies, they fall in share price more than yield can pay, giving investors an overall net loss. So take this for example, okay? I'm not hating on AT&T stock. I have my opinion on them, but this is an example. If you were to invest $10,000 into AT&T in 2016 and leave it to today, you would have started at $39 per share. It's now at $24 a share. Your total investment would have been $10,000, and now it's worth $8,500. You would have lost a total return of 14.31%. AT&T is an example of a stock that's a very high yield, but is not sustaining through share price appreciation or doing anything like that, okay? They're actually cutting the dividend yield by half, by 50%, doing different plays with their company and a lot of debt. Now, they're reducing it. We're not going into that. But a lot of the time that these companies do have high yields, it's because their share price is falling. Like take, for example, just think about it in your mind, a $100 stock with a 1% yield, okay? The stock falls to 50% to $50. Well, it still has that $1 payout, so technically it's got a 2% yield. The yield increased, but the payout did not. The share price decreased and the yield increased. So it's different things like that, and high yield chasing is not the way to go when it comes to dividend stock investing. Rule number 2, the payout ratio must be sustainable. So what is the payout ratio? Your dividend payout ratio is the amount of net income being paid to shareholders in dividends. So put it in simple example. Let's say company ABC makes $100 in net income. They pay out $60 in dividends to their shareholders. That's a 60% payout ratio. 60 divided by 100, 60%. And this rule is kind of similar to rule number 1 because companies with a high payout ratio will often cut or reduce their dividends. So take these for example. Microsoft, one of my favorite dividend stocks, okay? Probably my favorite dividend growth stock right now. Look at all these great grades. The only thing is the dividend yield is a D plus because it's a low dividend yield. It's 0.73%. But they have a payout ratio of 27.06%, which is very, very sustainable. Now, I'm not going to tell you what payout ratios are sustainable and which ones aren't because some companies can't sustain an 80% payout ratio. Like Altria. REITs have to pay a 90% dividend payout ratio on taxable net income because it's the way that it's formed by the law. And different companies can sustain better ones. The lower, the better. But usually lower payout ratio means a lower dividend yield. And take this company for example, 1OK. All these grades are C, not that good, and they have a payout ratio of 109%, a dividend growth of 0 years because they can't sustain that dividend. Now, they attract these investors with a very high dividend yield of 5.77%, but it's not sustainable, okay? So do not go yield chasing. If you're going to find a company with a high yield, make sure that the payout ratio is very solid, okay? That is very, very important. And also, furthermore, if a company has a really high payout ratio, they're not using their money efficiently. They should be using some of their earnings to reinvest into their company and provide better value and innovation to shareholders. And we talked about this. REITs have high payout ratios because they are required to pay at least 90% of their net earnings to shareholders via dividends. Now let's talk about rule number 3. Quality overrules quantity. Best quote from legendary investor Warren Buffett. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Do not just buy a company because it's dipped. Make sure that you know why a company and why you're buying the dip. Just because the stock has recently fell does not mean it will go back up. Most of the time that these companies fall, it's for a good reason. Now, you can say like, oh, well, Hunter, you literally just bought Upwork because it was at 62 a share, now it's at 40. I've been invested in this company for a while. I could explain like the back of my hand why I'm invested in this company, but we'll not go into it in this video. And it's why I'm buying this great company at a fair price. Okay, now, part number 2. There are a lot of great companies in the market, but it's not necessary to have too many holdings. You don't want to have so many holdings that your portfolio is like insane. That's what ETFs were invented for. Own an ETF, own SPY, own something like that, rather than having like 150 holdings, unless you're doing nothing but able to manage every single holding. Like maybe all you do is look at stocks all day and you can actually manage these holdings, okay? Invest in companies that you have 100% conviction in. It's very hard to have conviction in like 90 stocks, okay? So you have to know every single company, have an explanation on why you're invested in these companies. Now, a company with a lower yield will always overrule a company with a high risky yield. Now, what this means is a company with a quality, high payout, low payout ratio, a quality yield that is going to sustain for the long term will always outbeat a company with a risky high yield, which won't be able to sustain it in the long term. You're better with quality over quantity. Now, rule number 4, only invest in what you understand. This kind of rolls back to rule number 3, but invest in companies where you can explain why you're investing in them, and not only that the stock is going to go up or because somebody told you that the stock is going to go up or that they have a good yield. If you can't understand the company, you can't have complete conviction on them. And in red days, are you going to sell? And in bear markets, are you going to sell? Like you have to understand and think in a long-term analysis on why you're invested in this company. And also, don't invest in a company just because someone told you to and that they believe in the company. Like me, for example, I post these videos about why I invested in this stock or why I'm not invested in this stock. You need to have your own conviction at the end of the day, because at the end of the day, you're the person who's buying the stock. You're the owner of those shares. You're the owner of the company, and it's not me. Now, sure, we both are, but it's your money that you're playing with, not mine, not somebody else's. You're the one who needs to take responsibility of your investments and be sure that you're invested in a company for X, Y, Z reason. Now, rule number 5, don't be afraid to sell a stock. Nobody ever went broke from taking profits. I know I have stocks that I've bought that don't do good. Okay. Especially when I started investing. Like there was times when I invested in a stock and it just did not do good. Like take for example, I invested in a SPAC, IPOF. I bought it like $14 a share. It went up to like 16, and this was like a year ago, I want to say, maybe even longer than that. I bought it like 14 a share, it went up to 16, and I should have taken my profits. I was like, no, it's gonna keep going up, and then it fell to 10, and it literally has not touched 11 since it fell to 10, and I cut my losses at 10, and it could have fallen more to 9. People who invested in PaySafe, the stock was like literally just at $12. It went to 8 to 7, and now it's like $3 a share. You gotta be sure to take losses. Okay, cut your losses when necessary. Now, it can be tempting to think that whenever you buy a stock in the gains, it just keeps going up, and you're tempted to just be like, oh no, it's gonna keep going up. But if you have reasons to think a stock is perfectly valued or overvalued and trading at a premium, don't be afraid to lock in profits. And also, if a company changes like their kind of business model and your initial thesis and reasoning to why you bought them, don't be scared to sell. Now, if the company changes their model and you're like really liking it and you think this company has potential, reevaluate your initial purchase in the new path of the company and decide if it's worth selling or keeping that stock in your portfolio. But everybody, that's what I have for you in this video. So if you did enjoy it, make sure to give the video a thumbs up and you subscribe. You turn on those post notifications for videos coming out every other day. Thank you so much for the channel. Thank you so much for all the support you've been getting me. My videos have been doing incredible. This one has 7.2 thousand views, which is insane stuff. Thank you so much for making it to the end of the video. Check out M1 Finance. You can check out my portfolio. Also, you can check it out and get free $50. All that good stuff using links in the description and the comments below. Thank you again, and I will see you at the next video.